How about now? Can you all hear me now? Much better. Terrific. Okay, great. Thanks, everyone. Sorry about that. Um, Apparently we had a microphone issue. All right. Well, now it's like I'm doing the traffic, from, whatever helicopter I might be flying in. But okay, let me just back up a slide or two here to just kind of restart. So from a planning standpoint, when you get to retirement, one of the things you need to consider is that your after-tax savings picture is not the same as your before-tax savings picture. So if you have a traditional IRA, if you have a traditional 403b, 457, 401k, those are work savings plans, by the way. But if you have any of those devices or any of those plans, when you get to retirement, you own about 2/3 of that plan. The federal government, Uncle Sam, owns the other third. So this example here, if you have $500,000 in your 401k, 403b, 457, your IRA, any of those things that might say the word traditional close to them, when you go to pull the money out, every last dollar is taxable to you. Uncle Sam has his hand in your pocket for about anywhere from a quarter to a third of that. Your state might have their hand in your pocket for 10 to 12% of that, right? So 500,000 in one of these investment vehicles is not 500,000 to you. It's closer to 30, you know, 50 to 60% of that total value will be available for you. So one of the important things to remember too is those vehicles, it doesn't mean that they're bad savings vehicles. They're great savings vehicles while you're working because they are always or almost always after tax dollars or before tax dollars, which means that, hey, if I had 100,000 and I put $15,000 into my 401k this year, well, of my $100,000 of earned income, really, I'm only going to get taxed on 85,000 because that money went into the 401k. You never paid taxes on it. Okay. From an after-tax standpoint, though, that's where the challenge comes in. That's where the planning comes into play because you can see on these different charts here what the distributions look like if you're at a 0, a 12, or a 33% tax bracket, right? Your distribution in 15 years, if you can keep it at a 0% tax bracket, is going to be based on, right around $1 million, maybe about 1.2, 1.3 million. Well, if you're in the 12% tax bracket, it's about $1 million. If you're struggling to get out of the 33% tax bracket, it's more like 750,000. And so when we look at the after-tax value of the accounts, that's what we have to plan for. Now, those of you who've worked with me and our team, you know that we are huge believers in a concept called income flooring. The idea of income flooring is that half to 2/3, maybe even more, of your retirement income is going to come from fixed and guaranteed sources like Social Security, like pensions, like annuity guarantees from insurance companies, things like that. And so a lot of people will say, well, hey, that's okay, right? Because I have this guaranteed income. Social Security, I had a great career. Social Security is going to work out. Well, okay, but you got to recognize those have tax traps as well. So let's just talk about Social Security. You remember Bill's almost 41% tax rate, right? He only pulled out $1,000. He was in the 22% tax bracket. How on earth did he end up at a 41% tax level on that $1,000? Well, what happened is that $1,000 was enough to trigger him moving up to the next bracket in terms of how his Social Security benefits get taxed. Moving into that next bracket for just his Social Security benefit tax rate pushed his taxable income up significantly. Essentially, for every dollar he pulled out of there, it added $1.85 to his adjusted gross income. That took his total income tax from about $58.30 to $62.37, which means that's a $407 increase. Who knew? Right? That's called, if you want to look this up, it's called the Social Security tax torpedo. You got to watch out for that. Another thing to think about is Medicare and taxes, okay? Where income taxes are a progressive system. And what I mean by that is if you're in the 10%, your first dollars might get taxed at 10%, then you're taxed at 12 on the dollars that are over that threshold. at 22, your tax, dollars are taxed. It gradually grows over time, right? So if I have $300,000 of income, the income at the top, that pushed me to all the way to 300 is going to get taxed at a higher rate than say the first $20,000 of income did. That's why when you look at your 1040, it'll say your real tax rate, right? Or your effective tax rate. Well, IRMA, which is income related monthly adjustment amount, this is the means testing for your Medicare. IRMA doesn't work that way. IRMA has a cliff, which basically means if you go $1 into the next bracket, your Medicare premiums will change, right? They will line up with whatever is in that next bracket. So here, let me just back up. Here we have this great couple, George and Martha. They had $322,000 of modified adjusted gross income, and they sold some stock. They got a $1,000 gain. They think they should owe $188. Okay, where did $188 come from? Well, the 15 is the long-term capital gains tax rate. The 3.8 is the net investment income tax. So that's where the 188 came from. So that's what they're thinking. Hey, and they know these things, right? They pay attention. Well, guess what happens? 2 years later, they're going to look at their January Social Security statement, and it's going to show that their Medicare premiums, because Medicare gets deducted from your Social Security, they're going to open up that Social Security statement and they're going to be like, wait a second, why are we spending almost an extra $105 per person just on our Part B, and then another, call it $50 a person for our Part D. Part B is your doctor visits. Part D is your prescription drug coverage. Well, the reason why is because just taking that extra 1,000 out pushed them over this 322,000 threshold into the next level. By ending up in the next level, their Medicare bills went up, but the Medicare bills didn't go up for that year. They went up 2 years later. And so what that means is that's plenty of time to forget that you sold some stock a couple years ago, right? So, that's one of those things. It's another one of those gotchas. Right? It's another one of those gotchas. So we have to watch out for that. And that's why when those of you are working with us, when we're talking about tax planning, if state income tax applies, we're always asking about that. Federal income tax applies, we're always asking about that. IRMA will apply. When you start getting up to 62, 63 years old, we're going to start asking about that, right? Because we got to make sure we plan for these things. Because you might read, hey, you know what? I get into my retirement years and look at that top line. If you're under 206,000 of modified adjusted gross income for IRMA, you're thinking it's $175 a person. So you're thinking, hey, okay, my Medicare budget is $350 a month. But if you're really in this $322,000 to $386,000 modified adjusted gross income bracket, it's really $454 a month. That's, call it $900. And that's just the Part B. That's a lot different than 350, right? So these are things we need to make sure we understand. So George and Martha, did they have to pay the $188 long-term capital gains plus net investment income tax? They did. 2 years later, IRMA is going to kick in. Their Medicare is going to go up by $2,834. And when you add all that up, including their Part D, now you're at almost $3,200. That's a 320% tax rate. And that does not factor in your state income taxes if those apply to you as well. So hopefully you're seeing that there are some real serious tax planning issues we need to make sure we're talking about when we're working with our clients, because we've got to make sure that, hey, that extra 1,000, it's not just a question of, yeah, you can afford it. It's hey, let me take a look at where your adjusted gross income was last year. Let me take a look at the IRMA cliffs. Let's just check it, right? Because maybe you have $1,000 sitting in a CD or $1,000 in a savings account that you could pull the money out of and not have this issue. Okay. I'm going to kind of blast past Medicare enrollment. Just remember with Medicare enrollment, if you are late, you are looking at, like, if you forget to sign up, you're looking at a 10% lifetime penalty that will be added on to whatever premiums you're paying. So make sure you sign up for Medicare on time. Just remember, you have a window that starts 3 months before you turn 65. You have the month you turn 65. You have another 3 months after 65. If you're working at 65, you have 8 months from the time you separate from service to get signed up. And hey, if you did forget, you got to wait till the first quarter of the following year, get signed up. Coverage will start approximately a month after you get signed up. It's if you forgot, right? If your spouse is working and covered by group insurance at work, don't worry about it. If your spouse is 65 and you're working, you're covered, but they're not, they need to get signed up. Okay. Just remember 3 months before you turn 65, the month you turn 65, 3 months after. That's if you're retired, all that. If you're working and you're covered by a group employer plan, you got 8 months to get signed up for Part B. I should mention you have 63 days to get signed up for Part D. Every now and then someone will say, why 65? Why the difference? I wish I knew. I wish I knew. So that's Social Security and Medicare, right? We got to watch out for those. We got to watch out for those. Third key, what order am I going to withdraw assets from? Okay, what type of account? Taxable, tax-free, or tax-deferred? Okay. One of the things we end up talking a lot with people about is a Roth conversion strategy. One, you will notice with us, we are always talking about take a long-term approach with it. If you can stretch that out over 5, 10, or 15 years, fantastic. The reason why is you can gradually move those monies into a Roth, which is not taxable when you pull the money out, assuming it's sat there at least 5 years. And on top of that, has no required minimum distribution either. Okay. So if you can get money into Roth IRAs, you're going to want to do it smart. Right? You're going to want to make sure that you just convert enough at a time to not blow up your income taxes at the state or federal level, but also that you're not going to blow up your IRMA. Because when you do a Roth conversion, look at the bottom bullet point on this slide. Bottom line says it all. The conversion is considered taxable income. It does not count as your required minimum distribution. So when we're working with Roth conversions, what we're trying to do is stay within the same tax bracket if at all possible. So you can see here, I'm going to look to my right a little bit. If you see here, you can see you've got before conversion and then after conversion. From a before conversion standpoint, you're in the 10, 12, 22% tax bracket. You can see part of that 22 is blue, part of it's black. Well, maybe we convert enough to keep you in the 22% tax bracket. But remember, it's a progressive tax system when it comes to income taxes. So if I filled up the 22% bracket, okay, my first $10,000 or $15,000 of income was taxed at 10%. Then the next amount was taxed at 12. The next amount was at 22. Well, it's only when I go over the 22 bracket, it's just the dollars I went over get taxed at 24%. Is that going to make or break you from a tax standpoint? Probably not. But if we pushed you all the way to 32 or 35 or 37, could that make or break you? Yeah, it could. Yeah, it could. So unless you want to pay a lot in income taxes, you're going to want to stretch it out. And remember, conversions are always taxable. So taxed at the state level, taxed at the federal level. Couple other ways that you can manage your tax bill. One is if you do have a life insurance policy that's built up a lot of cash value over time, what a lot of people don't know about life insurance is that you can pull the money out of those policies income tax free. Life insurance remains pretty much the only vehicle that allows you to take out your gains through a withdrawal standpoint, or excuse me, through a loan standpoint, but you can also take out your principal, the money you put into it, through a withdrawal. If you do it correctly, it's totally income tax free to you. If you're like me and you're a little bit of a late bloomer, right? You've got young kids at home, you're going to be over the age of 59 or 60 by the time kids are in or through college. Well, guess what? That cash value life insurance does not mess up your FAFSA. In addition to that, a lot of colleges don't ask about cash value life insurance either. So those life insurance policies that have cash value, they can be really beneficial. You're going to want to have us review them to make sure that they're going to work for you. So if you have some of those, let us know. If it's me, if it's Andrew, if it's Jason, if it's Ken, whoever your lead advisor is, let them know that you've got these and you want us to review them. Highly appreciated stock for no or low or no capital gains. I mentioned capital gains earlier. Capital gains tax rates, if your household income's under about 400,000 and you held the stock for at least 365 days, okay, at least 365, then you can sell and take advantage of that 15% capital gains tax bracket. Okay. That can be really beneficial to you versus the traditional IRA withdrawal, which is fully taxed at income tax levels. Okay. So if you've got the flexibility there, that's a great tax planning tool, is to have that brokerage account sitting there that you've got some highly appreciated stock, right? Because we can strategically pull money out of that, or maybe absorb some losses from that to help keep your taxable bill or taxable income as low as possible. Taking distributions from IRAs or 401ks. All right, now the time that this usually makes the most sense is maybe I'm waiting for Social Security. So I'll give you an example. Let's say I'm going to wait all the way to 70, but I retired at 65. Okay, well, okay, you're going to wait to get the big Social Security check at 70. In the meantime, withdraw the Social Security income that you would have received from your IRA. Is it going to be taxable to you? Yes. However, is your taxable income low right now because you retired? Yes. Does it help get your IRA balance down a little bit or manage the IRA? Yes. What's the impact there? Well, when you get into your 70s, the impact now becomes my RMDs are lower because my overall account balance isn't quite where it would have been if I had just let it grow the whole time. Okay. So they call that the Social Security blackout period. All right. Couple other things you can do: health savings account, qualified business income. Health savings accounts, once you get over the age of 65, they essentially act like Roth IRAs. Before 65, if you pull money out, you have to use it for medical related purposes to make sure it's not taxable to you. After 65, you can pull it out for any reason. So if you are still working and your employer offers an HSA and you're thinking, hey, you know what, I can only put so much in the 401k, I can only contribute so much to a Roth IRA outside of work, but they have this HSA, max out the HSA as well. Max that out as well. Qualified business income deduction, okay. That's a little more detailed than what most people get into in retirement. Essentially, you have an actual, going concern business, and you might qualify for the qualified business income deduction. For those of you who have those passion projects where maybe you could turn it into an LLC, it might be worth investigating. It really might, because that can have a significantly positive impact on your plan. One of the other things we need to consider is giving strategies and how that relates to tax planning. So here we have an example of a couple. They're basically, they just want to give away like $5,000 a year, but their standard deduction for 24 is at $32,000. Okay, unless they're itemizing and they're over that $32,000 limit, that $5,000 to charity isn't going to benefit them in any way from a tax planning standpoint. However, if they have an IRA and the person who owns the IRA is at least 70 and a half years old, they can take advantage of something called a qualified charitable distribution, which means you can pull up to $100,000 out, give it directly to a charity. You do not pay taxes on it when it comes out. And when you're at required minimum distribution age, it also counts as your RMD. So I want to give 5,000. It might make a little more sense, hey, I'm just going to pull my 5,000. Well, maybe not, right? Because you pulled 5,000. It didn't put you over the standard deduction. If I'm in the 24% tax bracket, I got to pay another $1,200, or I got to pay a $1,200 tax bill, which means the cost of that deduction is now pushing $3,600. Well, if I do it as a qualified charitable distribution, I literally just pull 5,000 out. So maybe you're thinking, $6,200, I can afford that. That's fine. I don't care about the tax bill. Okay, pull $6,200 and give it to them then, right? But the point is, you can put more money in the hands of the causes you believe in. And one of the things that a great tax attorney we work with, whose name is Nathaniel Landman, one of the things he always says to people is, hey, you know what? If you don't want to do this, you don't want to take the extra step, that's fine. Let's go to the federal government's website and figure out which agency you like the best, and let's just give it to them. So think about this seriously, right? This is one of those things that it definitely makes sense to look before you leap. All right, from a legacy standpoint, and everybody has a financial legacy. That's not to say that your emotional legacy, right? Your qualitative legacy is not going to be the most important thing, right? People are going to remember you for who you were, not necessarily how much money you had, right? But you're going to have a financial legacy that you leave behind. How about another test? Can people hear me? I heard a beep. I just reset my headset. All right, great. Thank you, Edith. Thank you. Okay, so I want to pass some assets on, right? I'm going to have this financial legacy. How does tax planning fit into that? Well, you got to organize your assets, right? So estate planning is still going to matter. Now, one of the things that can be a big threat to your legacy goal is not having the right mix of insurance, believe it or not. And this actually is a pretty serious tax issue. So a lot of people go into retirement thinking, hey, I just need to have my Medicare supplement, or my Medicare Advantage. I'm good to go. What a lot of people fail to appreciate is that Medicare will not help you in any way with a long-term care issue. Long-term care is extended care, it's chronic care. It's when you need help with what are called activities of daily living. Things like getting out of bed, taking a bath, going to the bathroom, eating food, stuff like that. Okay. If I buy a traditional long-term care, a LTCI policy, okay, which are approved pretty much in every state, that essentially works like auto insurance. Okay, so rates are not guaranteed with those policies. They will go up periodically, and it's a true use it or lose it type of proposition, which means if you never have a long-term care issue, the policy you bought, hey, when you die, it just goes away. The insurance company probably doesn't even say thank you, right? It's over. You spent money on insurance that ultimately you never used. However, if you go with original long-term care insurance, or traditional long-term care insurance, there are deductibility options at the state and federal level. So that can help from a tax planning standpoint. Is it enough to offset the uncertainty of ever using the policy? Potentially. Most of the time it isn't. Okay. Now, you do need to remember, if you use a traditional policy, maybe you used an annuity-based long-term care policy or a life insurance-based long-term care policy, anything you get from a reimbursement of medical expenses or for long-term care expenses is going to be income tax free to you. Just make sure you stay under the IRS per diem, which in 2024 is like $12,000 a month. Don't quote me exactly on that. But even if you have an indemnity program versus a reimbursement program, if you just track your receipts, that's going to be fully income tax free to you as well. However, payments are going to be tax free. That's the key point there. But choosing how to pay for those long-term care costs will have a big impact. Here's an example, okay? And just think about your numbers, right? Like maybe your numbers are better than this, worse than this, or maybe this is right where you're at, okay? But just think about this for a second. So here we have a lady, she's in a long-term care scenario, so she needs help with some of those activities I talked about, and she's getting $60,000 a year of care. All right, that's what she's spending. Someone's coming to her house, she's spending $60,000 a year. She has her Social Security, she has her IRA. She also bought a life insurance policy that has a long-term care rider on it. Okay, that would pay up to $10,000 a month of her long-term care expenses. If she dies and never uses it, the kids get $500,000 tax-free. So the question this should be teeing up for you is, wait a second, does it make sense to pull money out of the IRA, or does it make sense to use the life insurance with the long-term care rider on it? Because keep in mind as well, at the federal level, anytime you spend more than 7.5% of your adjusted gross income on healthcare costs, that is now deductible to you. So that's a wrinkle, right? The other thing is, maybe it's really important to Florence to leave as much money as she can to her kids or grandkids. Well, she's got high deductibles for her unreimbursed medical expenses. Her income tax is probably pretty minimal, right? Maybe she spends down half of the IRA, never touches the life insurance, and now the kids get $500,000 of life insurance, which is completely income tax free to them. They still get whatever's left over in the IRA, which they have 10 years to get the money out of that account, and they'll pay taxes on it as it comes out. Alternatively, she could leave the IRA alone, use the life insurance with long-term care coverage for exactly what it was intended for, which was to help with this scenario. Now the kids get whatever's left over with the long-term care, and then they also get the IRA. It's up to her, right? It's her decision. So if she uses the IRA, She preserves the $500,000. The kids get tax-free from the insurance. The question really comes down to, do you want to use up the taxable money or do you want to use the tax-free money, just knowing that whatever's left over, you're going to pass it on? I would take this question one step further. Do I want to leave the tax-free money behind or do I want to leave the taxable money behind? Because they're going to pay the tax bill on it. It's up to you, right? And there's no right answer, right? It's just, these are things you need to be aware of. So how do we manage this? Well, okay. I do agree that you've got essentially 4 phases of retirement. Earlier, in earlier years, this used to actually have age ranges on it. I'm really glad the age ranges aren't on there anymore, because some people might be ready to retire at 50. Some people might love what they do and they really aren't serious about retiring until they get into their 70s, right? Or maybe even beyond. So there's this pre-retirement. Remember back to what I said way at the beginning. In pre-retirement, you got to make sure you understand your after-tax savings picture before you retire. Remember, Uncle Sam has his hand in your pocket for about a third of your traditional IRAs, your 457, 401k, 403b, all those traditional savings vehicles. The state, your state, if they have an income tax, probably has their hand in their pocket for anywhere from 8 to another 12%, or maybe even higher. So pre-retirement, what is my after-tax savings picture? Get as much money into the tax-free bucket as you can. What's in the tax-free bucket? Roth IRAs, cash value life insurance. Those are your 2 tax-free buckets, okay? Roth IRAs, cash value life insurance. Roth IRAs, you put the money in, you already paid taxes on it. When you pull the money out, it's going to be tax-free to you. Also, no required minimum distributions with Roth IRAs. Permanent life insurance that builds up a cash value. Remember, you can withdraw your basis with no tax implications. You can take policy loans against the gains with no tax implications. By the way, my policy that I have, my permanent policy, is with Prudential. I checked their preferred loan rate right now, even in this high interest rate environment. Their preferred loan rate currently is 2%. I could take a loan that's only 2% in interest. Would I rather take a loan and pay 2% interest or pay a third in income taxes? I'll take the loan. Thank you. I will absolutely take the loan. So know that pre-retirement picture. Early retirement. Okay, how does Social Security work? Remember that example, the guy who took the concert road trip? He got crushed because he took an extra $1,000 out, and it was the Social Security tax torpedo. Remember the other couple that sold some stock at what they thought was just going to be an 18% tax rate, right? They got crushed from an IRMA standpoint on their Medicare a couple years later, right? So we got to be thinking about, hey, what's the real impact of me taking money out of different spots? The other thing, that second bullet point down there, fill in the tax brackets in your lower income earning years. Remember, I talked about that Social Security blackout period, especially. That's a great time to draw down or do Roth conversions, right? Get money out of that traditional IRA, move it into a Roth, move it into permanent insurance, or just spend it, right? But you're getting that money out of that account. You're moving it over to the tax-free bucket. Mid-retirement, this is your mid-70s and older. You've got required minimum distributions. You've got to take money out. You've got to manage those. You've got to have a good understanding of what those mean. Keep doing Roth conversions, though, because there's no age limit on Roth conversions. Just remember, though, a Roth conversion does not count as an RMD. And then when you're in your later years, think strategically, right? You've been thinking strategically your entire life. Don't stop just because you're retired. Think strategically about, hey, this is how I could do this. This means the kids and the grandkids get the most tax-free money as possible. This means I get the most tax-free money while I'm alive. They get whatever's left over. Fine, right? Neither one of those is the right answer, because guess what? Your answer is the right answer. That's why you have to have a strategy. So we want to anticipate when and how we're going to pull money out. Those of you who are working with us already, we spend a lot of time working through that. We need to make sure we understand the range of taxes you're going to face at different levels. So hopefully I've demonstrated today that we have a good understanding of that as well. And then also a strategy that helps you do things the right way, right? Sometimes, as we all know, it's just, hey, if you're trying to put together an IKEA bookshelf and you do it in the wrong order, it screws the whole thing up, right? I grew up working on cars. I put a clutch in backwards one time on a car. That doesn't work, right? I know that, right? But you've got to manage your actions so you're doing the right things at the right time. And that's the key, right? Don't put the clutch in backwards, right? It's just not going to work if you do. And just keep in mind, keep learning, keep working with us. Tell your friends and family about us, because a lot of our peers out there, they don't even want to talk about taxes. They just say, hey, go talk to your accountant, your enrolled agent, or your tax attorney. But set up some time with us. I know we have some people on the call that we're working with on a really, in-depth basis. We have some people on the call, though, who haven't started working with us yet. That's okay, right? All you need to do is reach out and set up a taxes and retirement planning meeting. You can see my name there, Kenneth Hamilton. He's one of our partners as well. Jason Defoe, Andrew Paz. We are all certified financial planners. If you're not sure, just send us an email, admin@mfplanners.com, 888-339-0093. Given that we had some audio issues today, we will do a re-recording of this, might push it back a couple days in terms of getting it out there. But let me go ahead and just double check. I do got to apologize. Running solo today. Looks like I did not turn the chat on. Thank you for pointing that out, folks. Question. So this question came in. Why not put a significant amount of your money before retirement into a Roth instead of a 401k or 403b? That's a fantastic question. And that's actually something my wife and I do. So my wife has, and this, you're going to want to check with your employer on this, right? My wife, her employer has a Roth 401k and a traditional 401k. So what we've done ever since they put that in is we have always maxed out the Roth 401k. Now, an accountant would tell you, oh my gosh, you're blowing up your taxable income by doing that, because that extra $22,000 or $23,000 that goes in there every year is now you're paying taxes on it before you put in. Well, I also am the owner of 2 LLCs. My adjusted gross income, for example, because of the LLCs in 21 was about $10,000. Suddenly we're not blowing up our tax bill anymore, right? Even if I did have a quote unquote regular job where I was employed by someone else, you'd still want to put money in there. And the reason why is it will be totally tax-free to you when it comes out. You won't have the RMD. And then something I didn't really touch on with Roths is that when you die, that money also passes on to your named beneficiary tax-free as well. So great question. Yes, I strongly believe you should put as much money as you can into a Roth. If you don't have the Roth 401k option at work, and even if you make too much money, there's a strategy called a backdoor Roth conversion. It's essentially this. There's no time limit for how long money has to be in a traditional IRA before you can do a Roth conversion. So you literally at the end of the year could say, okay, I'm 51. I'm going to make my $8,000 Roth or traditional IRA contribution this year. And then I'm going to, the day after the money hits the account, I'm going to convert it, 100% of it, to a Roth IRA. That is a legal strategy for people to be able, who make too much money, to be able to get money into Roth IRAs every year. The other thing I would say is use permanent life insurance. Boring old whole life insurance, indexed universal life insurance, variable universal life insurance. All 3 of those will build up a significant cash value if you get them young enough and you fund them. Remember what I said about those. You can pull money out of those income tax-free as well. So absolutely. Great question. Great question. Another question came in. Is selling stock at low capital gains, is the 400,000 a growth? Yeah. Okay. So what you're getting at is, at the federal level, what's the income limit, the adjusted gross income limit, to be able to take advantage of that 15% capital gains tax rate? It's I don't have the exact number in front of me. It's right around $400,000 in 2024. Most of those things today are indexed for inflation, so it'll probably have gone up going into next year. But just keep in mind, you've got if your total adjusted gross income is under 400 and you held the stock at least 365 days, okay, that's a big key. Yeah, you'll be at that 15% capital gains tax bracket. Okay, I will keep the line open for just a couple more minutes. But otherwise, if anyone has any other questions, feel free to put them into the Q&A. I'm just going through and checking off. Thank you for all the people who are trying to grab my attention to say, hey, we can't hear you. I really do appreciate that. Okay. We go. Jeff, you're welcome. Thanks for making the time. I know how busy you are. Any other questions from anyone? All right. Well, thank you, everyone. Thanks again for making time to join us. Next week's workshop is at the same time. It'll be on Zoom. The microphones will work, I promise. It's about estate planning. Okay. So I'm going to give you this as a little primer. Estate planning is for everybody. It is not just for quote unquote rich people. Okay. The whole point of estate planning is to make sure that the stuff you've accumulated over the course of your life goes to the people you want it to go to in an easy fashion, in an orderly fashion, in a legal fashion, with minimum confusion, right? That's the whole point. Another huge part of estate planning is making sure you've got medical directives in place. And I'll talk about this next week. I went through this personally where a dear loved one had not done any of that stuff, and he was laying in a hospital bed, unable to make decisions for himself. There was no direction, right, at all. That's a horrible spot to put people in. If you don't have an estate plan, you at least need to have an estate plan that's going to have a will, a trust, and a medical directive at a minimum. Everybody should have that. Everybody's situation is unique, right? But at a minimum, you've got to make sure you know how your assets are going to pass on and that people can make decisions they need to make if you're unable to do it for yourself. Thank you so much, everyone, for making time. Thanks for putting up with us during our technical issues with the sound. I really do appreciate it. But otherwise, we will look forward to seeing most of you on the call next week. And otherwise, thanks again. Enjoy the rest of your week. We'll see you soon.